Welcome to another episode of Around the Grounds with the Property Baron. It's the 15th of May, 2026. I'm Jason Barron. Each week I'm joined by Nick Meredith, our man on the ground in Brisbane, and Hugo Fonseca, who leads the Property Baron Invest. This is where we catch up, we share all the insights about what we're seeing around the grounds, across Brisbane, the Sunshine Coast, Noosa, and what's happening in the investment space out there. No headlines, no hype, just real conversations, real insights of what's actually happening on the ground in the property market now. Special week this week, special episode. We're seeing the federal budget come out Tuesday night. So looking forward to having a chat about all the goings on with that with you two. Good morning, Nick and Hugo.
Yeah, good morning, guys.
Good morning.
So it's been a big week this week. Lots of talk about the budget. So looking forward to unpacking that and having a few discussions around our thoughts with it. Just before we do, I probably should sort of point out the three main points that relate to property that have come out. The first one's the changes to capital gains tax. In the past, we know that if an investor's held the property for more than 12 months, they can claim a capital gains discount on the sale, which is basically a discount of 50% relating to the whatever tax bracket the investor falls into. So that's the first one is the capital gains tax. The second one is negative gearing. In the past, a lot of people have bought property to get some negative gearing tax benefits on the property. Moving forward, anyone that buys a property after the budget that's an existing property will no longer be able to claim negative gearing on that property. They will be able to, however, claim the negative gearing benefits on any new property they buy or anything they buy off the plan. And anyone that holds investment properties that were bought before the budget, they'll be able to continue negatively gearing their properties as they normally would. The third thing is the changes to the trust distributions. In the past, people have been buying in different structures. Trust structure is one of them, and they can basically distribute the earnings from that trust with the beneficiaries and pay whatever tax bracket that beneficiary falls into. But trusts distributions are going to be blanketed with a 30% tax. Over to you guys. What do you guys think about the whole thing?
I'm going to defer to you here, Hugo. You've done a lot of work on this, so I'm really interested in your thoughts.
Mate, how long have you got? I know we've talked about this a lot, and obviously it's a topic that's front of mind for everyone. I honestly, personal view in one sentence, it's not going to deliver what it's apparently intended to deliver in terms of affordability. We can unpack it a little bit further and go into a bit more detail, but essentially you're creating a two-tier market. You're incentivizing more investment into the new build market. That market up until now has been heavily dominated by first homeowners because there's a lot of incentives on top that they get by buying new builds that were already existing. So we're now funneling a lot of that demand into the market that the first homeowners were trying to get into, and that is still an affordable market. So that's going to cause an overinflation in prices. You have supply constraints. You still have the same problems that we already had in terms of labor shortages, material costs, etc. So that's going to make it even more unaffordable on that side of the market. And then you've got the established properties. Existing investors still retain all the benefits. So they're either going to hold for as long as they can, and therefore there will be less supply available in established properties for sale, or they're going to try and maximize their returns so it's less negatively geared. So that could mean rental increases or conversion into short-term accommodation. And again, that's less supply from a rental point of view or more expensive rents. Or they exit the market and they end up selling off those properties, hopefully, and that is one of the objectives of the government, hopefully get bought by first homeowners or owner occupiers. But that, again, takes away from the rental supply pool and will put upward pressure on rents. There's one thing I want to say just on that. A lot of people are arguing that, well, if someone buys a property, then they're no longer a renter, and that's one less renter. That's not how things work. If you think about migration and population growth, everyone is going to rent first anyway. Yes, that first homeowner is no longer renting, but they've also bought a property that is going to, for a very long period of time, not be in the rental supply, and the number of renters continues to increase. You don't just reduce the number of renters by purchasing properties for first homeowners because there's new renters coming into the market, but you are definitely going to reduce the supply of properties for those renters.
Yeah, it's probably the people that are going to hurt the most is going to be the renters out there. They think that magically the renters are just going to turn into buyers and start buying houses. But the fact of the matter is a lot of people can't afford to buy houses and they need to rent. And with fewer rental properties coming on the market, with such huge demands out there and continuing to grow, I'm not sure if these incentives for the new dwellings are going to incentivize people enough to bring any sufficient amount of stock to market in the new space to counter, supply the demand for rentals.
I just wanted to bring up one thing that I did, sat there enthralled, like everyone watching the budget was, gee, must-see television that was. There was one point where they actually spoke about the market had become very inflated. There was, the market was too hot for what they wanted, and they wanted to slow things down, and this was a way of slowing things down and making it more accessible for everyone. They're the ones that changed the first home buyer guarantee from, let's just look in Brisbane as an example. On the 1st of October, it went from $750,000 up to $1 million overnight. All of a sudden, all these new people came into the market and thought, wow, this is a great opportunity. Places that were $750,000 in September basically became $900,000 plus properties all within a couple of weeks, because it just got so inflated because of the incentives that they put in place. And then it did what everyone said it was going to do. It inflated the market, got it really burning along, way too hot and that sort of thing. And then they've gone, oh, well, that's not acceptable. We need to change that. It was just the tail wagging the dog. Just showed really, it didn't seem like it was that hard to work out what was going to happen. And lo and behold, it happened.
Yeah, well, it's been a long time where the policymakers have seemed fairly disconnected with the people and what actually happens in the property markets, that's for sure. They're basically trying to sell this budget, and particularly the property-related topics, as a tool to deal with generational wealth inequality they're talking about. But what they're saying is it's going to slow the property market down. But with their own forecasts, they say that these measures are going to slow the property market growth down by 2%. So it's not going to go down to 2% growth. It's going to drop from wherever it is to 2%. And a lot of our markets have been, over the last year or two, have been in double-digit growth, so dropping it by 2% growth is not bringing it down that much and not making it much more affordable. Like you said, off the back of the first home buyers pushing up the property market, it's becoming more and more unaffordable for the first home buyers. And if you have those young people that want to try and achieve something in life, and potentially they say, look, I don't have the budget to buy where I want to live, so I'm going to buy a rental property somewhere else and do the whole rent vesting strategy to try and get ahead. These incentives or these things that they're implementing now are going to make it a lot harder for those young people to get in the property market with a rental property to try and build a base to eventually buy where they want to live later on.
Absolutely.
Isn't it ironic when you think about it? If you really reframe this whole situation, essentially what we're saying is, hey, all the things that were in place previously that helped ordinary Australians generate wealth and set themselves up for retirement, so negative gearing, capital gains tax, all the things that are being blamed for that intergenerational gap and unfairness that's been set in the system. What the government is saying is, hey, that worked really well for whoever got in when that was available. We will let everyone that got in keep it. For all you new investors or new homeowners, you no longer have access to it. So it worked really well, but you can't get it anymore, and we're making it fair for everyone. I don't know how that works. And to be honest, if it was about affordability, you would think it would only be applied to property. And that's one thing that's not being talked about. This applies now to all types of investments. So this isn't a housing affordability initiative. This is tax reform at the end of the day. If it was just about the housing affordability, it wouldn't apply to other assets. This is about generating more revenue, but it won't make anything easier for first homeowners or for renters in general. And I think we've taken a backward step here.
I was speaking to a financial advisor the other day, just after the budget, and I guess important to mention that nothing that we speak about on the podcast today, talking about finance, should be seen as advice. Obviously, we're just giving our opinion and having a bit of a chat about our thoughts on things. But I was speaking to a financial advisor who does a lot of, I guess, structuring and advising people on how to structure before they buy investment properties and build portfolios out and all that kind of thing. And he said that he's got some pretty good solutions to get around some of these things. So just advice to anyone that's listening who might want but doesn't know where they're sitting at. If they want to give us a call anytime, feel free to reach out. We can have a bit of a chat. But also, if you're looking to get some advice on structuring and different finance things, reach out as well, because we can put you in touch with some people that can help. Or just talk to your accountant. If you're not sure where you're at, where you're sitting at, talk to your accountant and have a chat about how that might impact your own personal circumstances.
Really good point. We always say how important having a strategy is from a property point of view, but we've also always called out how important it is to have a holistic approach to it and be surrounded by experts in their respective fields, right? Financial planners, accountants, brokers, etc. So now more than ever, it's critical that that people seek that advice and make sure that they set themselves up in a way that isn't going to be a hindrance or a detriment to their future success.
You might want to mention a few more things about what we're doing, Hugo, to help out with, I guess, analysing things and figure out what properties are doing what at the moment. We've built out a couple of tools that we've been using to help us figure out what might be the best strategies and opportunities for our clients.
Yeah. Are we're going to be sharing that with everyone, are we, Jays?
Well, we can have a talk about it.
Yeah, excellent. No, that's exciting. That's exciting because I wasn't sure whether that was going to be the case. We've certainly been benefiting from using these new tools that we've. They're excellent. One in particular we've set up. It's quite simple to use, and it actually allows you to compare the different scenarios and different tax outcomes based on whether you already own or owned properties prior to the budget announcement, or whether you buy an established versus a new build post the announcement. And it maps it all out and gives you the outcomes at point of sale when you end up selling it, whenever that date may be, and determines what the best possible pathway may be for your circumstances. So again, not financial advice. It's general. And it's just a projection tool per se. It doesn't take into account everyone's individual circumstances, but super helpful. So yeah, if anyone listening to the podcast wants to get access to that, just send us a message or get in touch, and we're more than happy to share.
Yeah, so comparing the performance over time versus if you bought before the budget, if you bought existing after the budget or new after the budget, it's really interesting to see what the end result is likely to be. One of the factors that, I guess that's an in-house tool that we use, right? One of the factors that we consider when we're building it out is the performance of the property that's being bought. So moving forward, if you're buying an investment property, you're going to get the negative gearing benefits from buying a new property, but not an existing property. One thing that we're talking about, or have been talking about this week since the budget, is that if you're buying a new property with the negative gearing benefits, and what you're effectively doing is you're going to probably be buying into a market competing with other buyers looking to buy new. It's probably going to be a competitive market. And once you buy that new property, in 6 to 12 months' time, once you've bought it, it's no longer going to be a new property. You're going to be, if you want to sell it, you're going to be selling it into a completely different market. So you're going to be buying it in the competitive new property space. Super competitive, prices are going to probably increase. And then you're going to be selling it into a market that's the existing market, which is not going to be as buoyant, particularly in those areas by investors, because the investors might be buying the new stock rather than the 6 or 12-month-old stock. So we've used the analogy this week. It kind of seems like it may turn out that it's like buying a new car. You buy it for a premium price, you drive it out of the lot, you need to sell it back into an existing car market, and we know that prices drop fairly considerably straight away.
Yeah, I think everyone needs to take a bit of a deep breath. Out there at the moment, there seems to be a lot of guys getting on social media platforms, yelling at their phones and yelling at people, telling them, the world's ending and it's doom and gloom. Forget it, just go out and buy new property now. Well, I think everyone needs to take a deep breath and let some proper analysis be done, because no matter what happens, the strategies and the fundamentals around property investing haven't changed. It's a long-term proposition. And if you're holding a property for the next 10 years, good luck trying to forecast what the capital gains tax laws or negative gearing laws will be in 10 years' time. You just got to stick to the fundamentals of buying the right property in the right area with the right fundamentals behind it, and you'll be fine. It's just trying to remove a bit of the hysteria at the moment, I think, is really important.
Yeah,
you're absolutely right,
100%,
Nick. It's a really good point.
Absolutely.
I think, Jace and Nick, so that point was excellent, because although we're obviously having a long chat here about what we think may happen or not happen and whether we agree or disagree with what's being done, at the end of the day, there's three things that are important to remember. One, none of this has passed through the House of Representatives or Parliament yet, and it may well change between now and then. Two, even if it does all get rolled out as proposed, who knows what's going to happen now at the next election or in subsequent years. This is just a rule change from a tax point of view. It doesn't change the fundamentals of real estate. It doesn't change the fact that real estate is a great investment asset to invest in. But yeah, it's not doom and gloom at the end of the day.
And we've already picked through a couple of what we think are pretty good strategies moving forward to take advantage of the good and bad and the ugly parts of this. So it'd be interesting to see what happens.
no one has a crystal ball, but what it does indicate and what it does seem to be doing is creating a two-tier system. It's going to push a lot of everyday mum and dad investors into the new build space. That new build space was already challenged from a supply point of view in terms of labor shortages, materials costs, and just the feasibility in general of projects taking off. And it's a market that is mostly dominated, I guess, by first homeowners. And that's where they go into because they get a lot of benefit and a lot of other incentives to go into that market. It's going to inflate prices. That premium and that advantage of being able to retain negative gearing and the choice of what capital gains tax treatment you choose at the point of sale, etc., will be baked into those prices. So we're going to see overpriced new builds, generally suboptimal locations. On the flip side, established property is mainly going to be dominated now by the ones that had already invested that are going to hold those properties, or wealthy investors that can hold and absorb those losses over time and don't need the negative gearing, and they can cover the gap. So it's really a two-tier environment. I don't see how it's going to make things more affordable, but it's certainly going to complicate things, particularly for renters. But from a first homeowner's point of view, it's not going to make it cheaper either. I don't know. What do you think?
Look, the new home buying space is a really interesting one because it's been undersupplied massively for such a long time. And the reasons for the undersupply are because construction costs have gone through the roof. Also, the approvals to get things approved, it's not always that easy. They've tried to, in the past, make it a bit easier for the approvals to go through, but that hasn't really increased supply because it's been too expensive to build. And when you've got an environment like that, a lack of trades there as well, if what they're doing does get a whole lot of investors to start investing in the new build space, it will undoubtedly push up prices of new builds through the roof. And it's not going to do anything for generation inequality or getting first home buyers into the market. It's going to just continue to push prices up of new stock. And I don't see, if we do get an uplift in investment in that space from the changes, I just don't see how they can bring enough supply to market to cater for the demand anyway. We're such massively undersupplied. So I just don't know if that's the best place or part of the market to put fuel on the fire to get more housing to market.
Yeah, we hear a lot of blaming and scapegoating on investors for the affordability situation that we find ourselves in with housing. But it's really not the case. If you really look into the numbers, we know that what's causing the unaffordability is the massive gap between demand and supply, and the fact that the government has been unable to plug that gap with supply. What people don't realize, and I hear a lot of this, and I really want to maybe use this opportunity to address it, because there's one side of the argument that believes that all investors, all landlords are just greedy, wealthy people that are just rolling in cash and are causing all of these issues. What people don't look at is that over 70% of real estate investors in Australia only own one property, and another 18 or 19% own two. So 90+% of anyone that owns an investment property has one or two. They're not playing Monopoly. They don't have 30 or 50 or 100 properties. They're not here to become billionaires. They're just establishing their nest egg and trying to establish some intergenerational wealth, I guess, that they can pass on to their kids. I think 90% of the rental supply is provided by those mom and dad investors that have one or two properties. If they leave the market or it's no longer affordable for them to be able to provide those, who's going to provide them? The government?
Yeah, I totally agree with you. It's definitely going to hurt those people trying to get ahead who, are not multi-million or billion-dollar companies. I'd like to argue against anyone that says it's the rich people that it's going to target, because a lot of the wealthier people that have got substantial portfolios, they're probably going to have different company structures and things in place where they're probably paying 25% company tax anyway. So the big guys, it's probably not going to hurt them too much. And who it's going to hurt or who it's going to hamper is going to be the mum and dad investors that might have one or two or three properties, or the government's own forecasts. They're forecasting that the price growth is going to slow down by 2%. So if it is in double digits or has been double digits, 10 or 12% in the last year, if it comes back by 2%, it's still going to grow substantially. What it means, one thing is that it's well worth getting in anyway. But The second thing is that what they're doing is not going to it's not going to slow down the property market, anywhere near enough to make it more affordable for anyone looking to get in the market. That's for sure.
No, and it can't slow down. That's the reality. We have a really high spending government. If for them to be able to spend as much as they have been spending, they need to generate revenue. Yeah, economics 101. That's a reality. This
Yep.
is going to generate increased tax revenues. This is going to deliver that increased revenue for them to continue to spend. And if property prices were to, let's say, come crashing down, right? So everything became affordable, if that was even possible without supply, what that would mean would be decreased government revenue, decreased stamp duty, decreased land tax, etc. The government can't afford to do that. So it's in their benefit for property prices to actually go up. Sure, it might go up by a little bit less, but they're not going to do something that is going to actually hurt the revenue streams that are coming into their coffers.
Yeah, and then just on that point, I think people still need to buy houses. People still need somewhere to live. There's going to be some our fundamental basics of what we look for in an investment property, and trying to buy into the predominantly owner-occupier markets where people want to live in centres that are well serviced by transport and in the higher population centres. Those kinds of investments are still going to be good places to buy. So we'll have to keep a close eye on all the different parts of the property markets out there to make sure that we're on top of it and ahead of the game, I guess.
Yeah, you know what? Those investment markets you're referring to, we've talked about this in the past, and I've had to think about what the impacts may be to those markets. Because we've seen and we know of areas across regional Australia that have been booming, for lack of a better description. And we know that that's been heavily investor-led, and the owner-occupier demand wasn't there. So it's turned those markets into unaffordable markets for first homeowners and for local owner occupiers. What this does now is all of those properties, even if they're high yielding and they might be appealing, not every investor may be able to now afford them without being able to use negative gearing. They're all established properties. And if they don't have that demand that existed prior to the budget announcement, and the owner occupiers and first homeowners in those more regional areas can't afford the existing prices to buy them off them, what happens there? Prices will have to come down in those areas because they were overinflated, and they were inflated by unusually speculative investor demand that we've never supported and have avoided doing ourselves. So I think there may be an impact there, either that or rents will become even higher in those areas to make it worthwhile from an investment point of view for those that are a bit more on the speculative side.
Yeah, and just on the capital gains changes that are coming in. So if someone's held a rental property in the past, if they've got plans to sell that rental property in the next 1, 2, 3, 4, 5 years, it's gonna make sense for them to sell it within the next year or two before the changes come in. Because they'll pay a portion of capital gains on the old system and a portion of capital gains on the new system potentially. So it could be an incentive or an opportunity for some of those investors to get out while they can, because if they continue to hold it for 5 or 10 years, if these changes do stay in place, the capital gains incentives are no longer going to be as beneficial to them. So I think there could be a bit of pressure on some investors to offload stock over the next 12 to 18 months. Some of those investor-led markets, which we've really tried to stay away from, they're not going to be able to sell it back into those markets because the new investors are not going to be buying existing stock in those markets. So they'll have to sell to owner-occupiers. Where we are on Noosa and the Sunshine Coast, it's a little bit different where, if someone's looking to offload an investment property for that reason, it could increase stock in a market that's predominantly an owner-occupier market. So the stock will likely get absorbed. There's probably going to be times where there may be a slight oversupply before it gets snapped up by the buyers. We'll certainly be watching that market closely locally where we are to make sure that we can jump on any opportunities of properties that have potentially come on for that reason and maybe sat on the market for a little while.
Yeah, those areas like the Sunshine Coast, as you mentioned, I think they'll be really strong for investors that can absorb and hold that negative gearing component over the longer term. At the end of the day, one thing we didn't mention is that you can carry forward those losses and offset them against income or capital gains later on down the track. So although there's no negative gearing, for those that can fill that gap, I guess, in terms of income versus expenses over the longer term and hold that, they'll be able to benefit, and they're still buying into the strongest markets, the ones that are owner-occupier driven and the ones that retain a high level of demand where they'll be able to absorb that stock if and when they decide to sell.
I did a little calculation this morning and was trying to figure out what we think may happen in the future, a bit of a prediction. May or may not come true. No one's got a crystal ball, but what we did was we had a look at, let's say we're an investor now and we buy a new property or we buy an existing property. Growth prospects over the long term, holding a new asset that is now no longer new, or buy an existing asset and holding the existing asset over time. There's probably going to be a difference in capital growth over time. The existing asset that you're buying is probably going to be have better property capital growth prospects because it's probably going to be in a better area, more desirable area. There's more owner-occupiers buying in the area. So that was one thing that we looked at. But the interesting calculation that we looked at was, okay, so let's say we buy an existing property and it's negatively geared by, let's say it's $200 a week, right? So it's negatively geared by $200 a week, and you say you're buying for $1 million, whatever it is. On the old system, you could claim the negative gearing tax incentives, which will save you a little bit of money. But let's say you don't get them anymore. You buy now and you hold a property over time. Let's say we use some pretty conservative capital growth figures, and you say the property is going to increase by 5%. Even though, past history said sort of 10, 12% or more in some of those areas. So your property of $1 million is going to go up by about $50,000 a year. That negative cash flow position might be a couple $100 a week. If it's a couple $100 a week that it's costing you to hold that asset, it's going to cost you around about $10,000 a year to hold in your money out. It costs you $10,000 to hold the property, but it's increasing in value by $50,000. There's a net increase of $40,000. When you work out those numbers, it might make sense for people to buy into an existing market that probably doesn't have as much competition as it has before. So you're potentially getting a good quality asset and something that's going to increase in value quite a lot.
Yeah, absolutely.
Advice?
Absolutely.
On that note, thank you everyone for listening. And don't forget to follow our podcast on your favorite podcast platform around the grounds. See you next time.